In terms of short-term GDP numbers, and you'll probably get them in the first week of June, I think everybody expects the GDP in the March quarter is going to be negative. In terms of looking a little bit down the track, these big increases in commodity prices, the income effects are still flowing through. There is massive increases in engineering, construction going on in the mining industry. And against that, the consumer is still scared. There's multi-speed economy, patchwork economy as Treasurer's now talking about, and we do have a Queensland rebuild and we do have an underbuild in housing. So basically what you're saying, short-term pain, medium-term this economy is going to pick up and grow quite strongly. On the dual-speed economy, this is some data out of our business survey, and it basically just runs through from December through to April. Plus 20 is a boom, minus 20 is a bust. What you see is the mining industry is very strong. Yes, it got hurt by the floods, but it's back. Manufacturing is really struggling because of the high dollar and also because of interest rates and currency. Construction is basically struggling if you're outside of mining because you're running towards the end of the government's stimulus package. Retail, wholesale's doing pretty poorly, particularly anything to do with discretionary spend. These are our business conditions index, and they're in aggregate. So on the left-hand side is basically trading and profit. The line that's sort of going down towards the end there was the mining problems associated with coal and the floods, and basically it's recovered. But broadly what you're saying is an economy that's running at about 2.75%. Forward orders have improved a bit, but overall basically pretty flat. Confidence. General levels of confidence in the Australian economy are about average, but big diversities across sectors. And on the right-hand side there, we've got in black a reading of confidence according to the general economy. And so you can see the miners vis-a-vis some of the other sectors, and particularly the mining, the manufacturing. The red line in there is basically an index that is at the top end of town. And so what it's sort of saying is if you talk to the miners, generally they're okay, but if you talk to BHP and Rio and those sort of people, they're really happy. House prices on the left-hand side, our expectations and expectations of professionals are that house prices are going to go sideways to down for about 6 months and then increase to about 4 or 5%. So if I'm looking at a profile for growth, and remember the government's forecasts are the same as ours, the bars down the bottom is our profile for GDP per quarter, and the line is 12 months to growth rates. So what we're basically saying is you've got an economy that sort of struggles for a little while at present because of the floods in particular, and then you've got the multi-speed economy. But the mining kick is so large, the rebuild of Queensland is so large, and the flow-through effects of these commodity prices to equity markets, etc., are so large that you get an economy that's sort of going up towards 5% growth rates. So on inflation, just another graph to sort of show you where we're at. Where the blue line is the core inflation, which the Reserve Bank is targeting, and it's already starting to go up. And by the end of the year, we think it's going to be close enough to 3. Reserve Bank, if you in the sort of green little triangles, actually are forecasting an increase in the CPI above the target. So what that says is they don't think that the flat or small increase in rates is enough. And what I'm saying to you is they won't have changed anything as a result of last night. So one of the other things that we see in the forecasts is these are our employment growths. If you have the economy growing the best part of 5% over the next 12 months, unemployment's going down. The blue line is unemployment, and we have it going down to about 4.25. The reason I put that arrow there is the Reserve Bank thinks whenever unemployment gets below 5, that generates wages pressures. So what this graph is basically saying is based on our forecast, which is the same as the government, the unemployment rate is for the next 18 months or 2 years is going to be below what the Reserve Bank would think would be the level that would generate wage pressure. So on the RBA, they are expecting a very strong increase in growth, stronger than what we're expecting. They are worried about higher oil prices, utility prices, fruit and veggie prices, basically pushing up the cost of living higher than what you might expect if you were just looking at the CPI. and they're ready to go. They've set it up basically to go as soon as possible. Whether they can get through in June, I mean, there's some, essentially I suppose there's some massaging of data. The week before the Reserve Bank meets in June, the national accounts come out. So you're going to have a situation where the economy is looking like it's going backwards. And so that might be difficult for the Reserve Bank, but they're going to be soon. If not June, then July. And then we think they're going to do another one later on. Thank you.